Okay, let's unpack this. What if I told you that a company focused on something as seemingly mundane, maybe even boring as swimming pools, could be incredibly interesting? And not just interesting, but maybe even a wonderful company at a fair price. That's a phrase, often linked to one of the greatest investors ever, Warren Buffett. Today, we're diving deep into Pool Corporation, ticker symbol POOL, POOL. They're the world's largest wholesale distributor of swimming pool supplies, equipment, and related outdoor leisure products. Now, this isn't just some random pick we pulled out of a hat. Berkshire Hathaway, Buffett's famous investment company, actually started buying shares in Pool Corp late last year, 2024, and kept going into early 2025. That kind of move, well, it immediately signals to any serious investor, or really anyone just curious about what makes a business tick, what makes it truly resilient and long-lasting, that this company is worth a closer look, a real deep dive. So our mission today is pretty clear. We want to really explore Pool Corp's business model, which is quite unique. We want to understand its competitive advantages, its moat, as we like to call it. We'll dig into its financials, analyze the market forces swirling around it, and look at its current outlook. The goal really is to grasp how this seemingly unexciting company became what some sharp analysts call a capital-light, moaty compounder. Basically, a business that doesn't need tons of cash to grow, is well protected from competitors, and just reliably builds wealth over time. We'll see how it does this with some powerful long-term tailwinds, even while it's navigating some, very real short-term headwinds right now.
Yeah, what's truly fascinating here, I think beyond just the nod from Berkshire, is seeing how a company in such a specific niche, pools, can build a business model that's just so robust, so resilient. You might think pools are just pools, right? But Pool Corp shows this real mastery of distribution, of customer service that kind of goes way beyond the simple product itself. We're going to try and connect the dots, basically, link the operational details, like how they run their warehouses, manage inventory, deal with customers, to the bigger economic picture. We want to show exactly why these details matter, not just for a stock price, but for understanding what drives a really successful business fundamentally. And for this deep dive, we've pulled together insights from a bunch of detailed investment analyses, some historical overviews tracing the journey, and crucially, their very latest Q2 2025 earnings report. So we're trying to get that full 360-degree view, past, present, and potential future.
All right, let's jump right in then. Part one, the business Pool Corp. What is Pool Corp? Anyway, so when you first think about owning a swimming pool, what comes to mind? For a lot of people, I bet it's the upkeep. The high energy costs, the constant chemicals, the cleaning, fixing things. It's a lot. It takes time and money.
Definitely. It's a commitment.
Yeah, and nearly everyone I've known who's owned a pool, including me way back when, had a person.
Yeah.
A pool guy, a service company, someone who came by regularly, maybe once a week, once a month, to handle all that stuff. Well, that person, that professional pool tech, or the company that builds the pools, or even your local independent pool store, that's the core customer for Pool Corp.
Exactly. And that's a really critical distinction people sometimes miss at first. Pool Corp isn't like your local Leslie's or something where you, the homeowner, just walk in for, chlorine tabs or a new skimmer net. Their core identity is being the world's biggest wholesale distributor. Think of it maybe like a Home Depot, but built exclusively for pool professionals. Their main customers are those smaller businesses. The independent installers, the maintenance guys, the local pool shops, often family-run places. These are businesses usually too small to buy directly from the hundreds of different manufacturers making every little part. Or, to keep a huge inventory themselves, they need someone to pull it all together.
Okay, so how do they actually manage that?
Yeah.
Getting tens of thousands of different parts to all those pool guys spread out everywhere. They use what's called a hub and spoke distribution model, and they've really perfected it. Picture Pool Corp as the main hub. They bring in this massive volume of products, like tens of thousands of different items, SKUs, everything from a tiny valve to a giant filter system from hundreds and hundreds of manufacturers.
Right, instead of the contractor juggling orders from 50 different places.
Exactly. Pool Corp handles all that aggregation. Then these products get distributed out to their, over 440 regional sales centers now?
Yeah, 448, I think, was the latest number.
Okay, 448. And it's important, like you said, these aren't retail stores. They're warehouses, distribution points. Spread across North America mostly, but also Europe, Australia, though heavily concentrated in the U.S. Sunbelt, obviously. This whole model lets those smaller pool businesses get everything they need way more efficiently, often better prices, better terms than trying to go direct. It's all about scale and logistics.
That hub and spoke system is just incredibly effective because it solves a real fundamental problem in a very fragmented market. Small businesses, they often struggle with complex supply chains, right? Dealing with tons of suppliers is a nightmare, costs more. Pool Corp steps in, lets these smaller guys benefit from its massive buying power, its slick logistics, it kind of levels the playing field for them. And the range of stuff they offer, it's huge. They really do have pretty much everything but the water. Huh. For essential maintenance, which, like you said, is that big recurring revenue driver, they've got all the chemicals, chlorine, bromine, algicides, pH stuff, testing kits, you name it. Management says something like, what, 65% of their revenue comes from just these maintenance items?
Wow, 65%.
Hmm.
That really highlights the stability, doesn't it? The recurring nature of a huge chunk of their business. It's not all just one-off builds, but yeah, it definitely doesn't stop at chemicals. They distribute the full range of equipment too. Pumps, filters, heaters, those fancy automation systems, robotic cleaners, lights, covers, and crucially, all the repair and replacement parts. Motors, cartridges, seals, valves, because stuff breaks, right?
Always does.
And for new builds or big renovations, they've got the materials. Tiles, finishes like plaster or pebble, decking, coping stones, all the plumbing bits. Now, here's where it gets interesting, showing some strategic thinking. They've been expanding into that broader backyard living space. Patio furniture, outdoor kitchens, grills, fire pits, water features, shade structures, stuff like that. It taps into that bigger trend of people creating, a whole outdoor oasis, not just a pool.
That expansion is, yeah, it's pretty smart. And it kind of makes you ask, okay, why bother with patio chairs if you sell chlorine? What's the strategy behind this diversification? It's really about grabbing a bigger slice of that whole outdoor living spend. Diversifying revenue, sure, but more importantly, capturing more of the homeowner's total budget for their backyard. They're moving beyond just the pool to the entire backyard experience. And they can do it because they already have the distribution network, the contractor relationships. It's not random. Look at their Horizon Distributors brand. That's their move into landscaping and irrigation, sprinklers, turf chemicals, outdoor lighting. A lot of that stuff, like pool chemicals, has recurring revenue too. So it fits, it complements the core business, and capitalizes on that big trend of investing in outdoor spaces.
Makes sense. And speaking of their footprint, geographically, you said North America is dominant.
Overwhelmingly, 96% of sales in 2024 were North America, US, Canada, Mexico. And within the US, yeah, about 54% comes from just 4 states: Florida, California, Texas, and Arizona. Makes sense, right? Warm weather, lots of pools.
The big 4 pool states.
Pretty much. But they are international too. Europe's about 4%, Australia less than 1%, and they're growing there. And their growth path has been steady. You mentioned the sales centers from 321 back in 2013 to 448 in 2024. That's through opening new ones and buying up competitors. They've really gone from a regional player to this multinational distribution giant. It's a key part of their story.
Okay, that evolution is fascinating, which brings us nicely into part 2. A look back at the history and evolution of a dominant player. So it started pretty small, right? Back in 1980.
Yeah, very modest beginnings. Founded in New Orleans by Frank St. Romain, who was a real pool industry veteran, been in it since '59, and Richard Smith. They called it South Central Pool Supply. And right from the start, they built this reputation for good service, reliable support, and really knowing what products their local customers needed. That foundation was crucial.
But it wasn't organic growth forever. Things really took off when venture capital got involved.
Exactly. In 1993, a VC firm saw the potential, bought the company, and brought in this strategy of growth through acquisition, buy up competitors, consolidate the market. That led to them going public in 1995 as SCB Pool. They used that IPO money to really fuel the acquisition engine, buying companies like Orcal, Aqua Chemical, Crest Distributions. And a key figure during this whole expansion was Manuel Perez de la Mesa Manny. He joined as COO, later became CEO for 20 years, really shaped the company's direction during that critical growth phase.
Right, Manny. And then came that really interesting move around 2000, 2001, acquiring Superior Pool Products and Hughes Supply's pool division. That wasn't just about getting bigger, was it?
No, that was strategically brilliant because it didn't just make them bigger, it established a second distinct distribution network operating alongside the original SCP network. It was a very deliberate dual network strategy. And there were 2 main reasons. First, give customers choice. Different contractors have different loyalties, maybe prefer certain brands or service styles. 2 networks let them cater to more preferences.
Okay, that makes sense. Offer more options.
And second, this is the really clever part, it was designed to foster internal competition. Having 2 networks running side by side allowed them to benchmark performance, push each other to improve customer service, innovate locally, get more efficient.
Wow. Okay, here's where it gets really interesting. Instead of just centralizing everything after buying companies, they deliberately encouraged internal competition. That tells you a lot about their focus on execution, doesn't it?
It absolutely does. It shows they value being responsive, being adaptable locally.
Yeah.
They understood that a one-size-fits-all approach might not work everywhere. It's probably harder to manage. But if you do it right, it creates this internal pressure cooker for better performance.
And did that focus on execution help them during tough times, like the great financial crisis?
Massively. Their revenue definitely took a hit during the GFC, like most companies. Fell from about $1.9 billion in '07 down to $1.5 billion in '09. But here's the kicker. Their gross margins stayed pretty much intact through that whole period.
Really, margins held up.
Yeah. Which speaks volumes about the non-discretionary nature of a lot of their business. Even when money's tight, pools still need chemicals, pools still break. You can't just ignore it.
That is powerful. Almost recession-resistant on the maintenance side, then.
To a large degree, yes, there's a limit. But that core maintenance need is very resilient.
Okay, so they navigate the GFC. Fast forward, new leadership comes in around 2018.
Right. Peter Arvan took over as CEO. He came with a strong background in Distribution Roofing Supply Group, GE. He's basically continued that same strategic focus on operational excellence, smart expansion.
And that brings us to today. 448 sales centers, over $5 billion in revenue, generating around $600 million in free cash flow. It's quite the machine they've built. Okay, now that we know the what and the how they got here, let's look at part 3. How it works, the engine room, basically. What makes Pool Corp actually run day to day? It starts with the manufacturers, right? Over 2,200 of them.
Yep. Chemical companies, hardware makers, tile producers, pump manufacturers, everyone.
Right.
And because Pool Corp buys in such huge volumes, they have serious leverage. It's not just about getting slightly better prices, though they do. It's about getting priority access to new products, better payment terms, things like that. For the manufacturers, Pool Corp is a dream customer. Reliable, high-volume orders. They're a crucial channel to market.
They're the darling client, basically.
Oh.
Okay, so they buy all this stuff in bulk, then it goes into that network of 448 sales centers, those regional warehouses.
Exactly. And each warehouse holds deep inventory, but it's localized. What sells well in Arizona might be different from Florida or New York. They tailor the stock. The overall strategy is central, but the day-to-day is very close to the customer. Products are stored near the job sites. That's key for speed.
Reduces waiting times. If a contractor needs a pump motor now, it's likely nearby.
Right. Prevents those costly delays.
Okay, so the stuff's in the local warehouse. Then the customers, builders, service techs, retail stores place their orders. How do they do that?
Multiple ways. Increasingly, they're using PWall 360. That's Pool Corp's online platform. Real-time inventory, pricing, ordering 24/7.
Makes sense. Digital ordering.
Yeah, but they can also still call their inside sales rep at the local warehouse, talk to a person who knows the products, knows their business.
And once the order's in?
2 options, basically. Delivered right to the job site, huge convenience for contractors juggling multiple locations. Or they can swing by the sales center and pick it up themselves. The whole system is designed for convenience and speed for the professional customer.
So it's way more than just being a middleman then. What's the real value add? Let's break that down.
Okay, first, supply aggregation. Like we said, pulling products from hundreds of manufacturers into one place. Imagine the nightmare for a small contractor trying to manage 50 different suppliers for one pool build. Pool Corp eliminates that headache.
Simplifies everything. Okay, what else?
Second, local inventory. Having those warehouses close by means pros get parts fast, often next day. Critical for repairs. No waiting weeks.
Huge for time-sensitive stuff.
Not it. Third, sophisticated logistics. They've invested heavily in optimizing deliveries. Just-in-time capabilities. Reduces costs. Boosts efficiency for everyone.
Okay, logistics. What about financial help?
Number 4, credit offerings. This is a big one. Offering flexible payment terms to small contractors who are often cash-strapped. Pool Corp acts like a crucial financial partner, helping them manage cash flow.
Right, that builds serious loyalty, I bet.
Absolutely. And finally, number 5, sales support. Their reps don't just take orders. They help contractors spec jobs, find the right parts, schedule deliveries. It's real technical and logistical support.
Okay, so aggregation, local inventory, logistics, credit, and support. That's a lot more than just moving boxes.
Exactly. If you connect this to the bigger picture, Pool Corp is providing this whole suite of essential services, logistical, financial, technical support that small businesses just couldn't replicate on their own. It makes them indispensable, and that insulates them from competition. They are the one-stop shop for the pool pro, and there's really no one else doing it at their scale. Trying to disrupt them would be incredibly expensive and difficult. You need the specialized knowledge, the local warehouses, or the relationships built over decades. It's not like Amazon can just jump in and take over. Pros need more than just cheap delivery. They need credit, expertise, immediate access to niche parts. It's a physical, local relationship business.
That perfectly sets up part 4, the unseen advantages Pool Corp's moat.
Mm-hmm.
So what does all this mean for defending their business? How do they keep competitors out? This is where that moat comes in, those sustainable advantages. It might not be the most flashy moat, maybe, but it seems incredibly effective. They don't really have major competitors breathing down their neck at the same scale.
That's right. And the moat isn't just one thing, it's several interlocking parts working together. First, you've got scale purchasing. Simple concept. Bigger buyers get better deals. Pool Corp's massive volume gives them huge leverage with suppliers. Better prices for customers, first dibs on new products, better payment terms. Suppliers love them because they're reliable, high volume. Sometimes they even get exclusive products.
And that scale means they can just carry way more stuff than smaller rivals, too, right? Makes them the true one-stop shop.
Exactly. Then number 2 is distribution density. Always nearby, always ready. Over 440 locations close to customers. That means faster delivery, reliable stock nearby, lower transport costs for the contractor. Like you said, if they need it tomorrow, Pool Corp can usually deliver.
That local presence is key. Plus redundancy. If one warehouse is out, another nearby can probably cover it.
Precisely. Optimized for proximity and citadinality. Huge service advantage.
Okay, scale, density. What's next?
Third is operational efficiency. Faster, cheaper, smarter. Decades of optimizing warehouses, inventory turnover, delivery routes, online ordering. Their scale lets them invest in tech predictive inventory, real-time tracking that smaller guys can't afford. It all translates to lower costs, fewer stockouts, better productivity. Helps protect their margins.
Makes sense. Efficiency keeps costs down. And then there's the customer side.
Fourth, absolutely, customer loyalty. Hard to put a price on trust. They serve these small to medium contractors who are time poor, often cash poor. Pool Corp gives them more than just products. They give them credit, technical help, personal service, reliable delivery. That builds incredibly strong relationships. Why would a contractor switch if Pool Corp consistently delivers? The hassle just isn't worth it unless something goes really wrong.
The switching costs are high, not just in money, but in time and trust.
Exactly. And finally, number 5, something maybe less obvious, proprietary products. You can't get it anywhere else. They control exclusive brands, especially their NPT National Pool Tile line. Tiles, finishes, decking materials, only available through them.
So that creates a lock-in effect.
Precisely. It builds brand preference, sure, but more importantly, structural lock-in. Imagine a contractor used a specific NPT tile 5 years ago. Homeowner wants an expansion or repair now. They have to go back to Pool Corp's NPT line to get a perfect match. Locked in. Plus, these proprietary and private label products usually have better margins for Pool Corp and face less direct price competition.
So this raises an important question then. How does that lock-in, combined with all that recurring maintenance revenue, really contribute to their long-term stability?
It means they get revenue streams not just from the constant maintenance, but also from future renovations and upgrades tied to those initial proprietary product sales. It makes the customer relationship even stickier, more profitable over the pool's entire life. All these advantages together, scale, density, efficiency, loyalty, proprietary products, make Pool Corp deeply embedded. Very hard to disrupt. With 65% recurring revenue plus that strong moat, they look really well set up for the long term.
Okay, let's shift gears now to part 5. Navigating the water's market dynamics and recent trends. Understanding the overall pool market is key here. We can kind of break down pool spending into 3 buckets, right? New pool construction. That's tied to housing, more cyclical.
Yeah, new builds are linked to new homes. Housing activity, more up and down, represents maybe 15–20% of total spending.
But here's where it gets really interesting. While new pools grab the headlines, the real consistent moneymaker, the bedrock, is the existing pools.
Absolutely. The vast majority, over 60% of spending, comes from ongoing maintenance and small repairs on the millions of pools already out there. It's like a subscription almost. Chemicals, cleaning, filters, stuff that has to be done good times or bad. Essential non-discretionary.
Right. And then there's another chunk, maybe 20–25%, from remodeling older pools.
Exactly. That huge installed base of pools gets older. They need resurfacing, new equipment, maybe cosmetic upgrades. That provides another steady stream of business.
Which leads us right into the whole COVID pool boom and what happened next. That really shook things up.
Oh, massively. During the pandemic, 2020 to 2022, people were stuck at home, often had extra cash, and they built pools like crazy. Something like 330,000 new pools in just those 2 years. Compare that to maybe 700,000 in the entire 10 years before that. It was a huge surge, a massive pull forward of demand.
Wow. And people were stocking up on supplies too, weren't they? Worried about shortages.
Yep. Homeowners were buying chemicals and parts way ahead, fearing supply chain issues. Pool Corp itself built up significant inventory, partly strategically.
So what did that pull forward mean afterwards? A hangover.
Pretty much. If we connect this to the bigger picture, that boom created shorter-term distortion, absolutely. Sales spiked, then growth stalled out. Revenue's been kind of flat since 2021 as things normalized. New construction cooled off, discretionary spending tightened, but, and this is crucial, it also created a massive long-term asset for Pool Corp. All those new pools, that expanded installed base is permanent. More pools mean more ongoing maintenance, more chemicals, more repairs, eventually more renovations for decades to come. It's a permanent tailwind, even if sales took a breather after the initial spike.
Makes sense. The base is bigger now. And demographics matter too, right? Housing shortages, interest rates. But those core Sunbelt states are still growing.
Definitely. High rates and housing issues impact new builds, sure. But those key states, Florida, California, Texas, Arizona, where Pool Corp gets half its revenue, are still seeing growth overall. And even with the recent slowdown in new pools, the total number of pools in the U.S. keeps ticking up over the long term. That installed base growth is fundamental.
And management seems focused on that existing base for future growth.
Yeah, their outlook reflects that reality. They expect future growth mainly from maintaining, upgrading, remodeling the millions of existing pools. New construction is still important, averages maybe 3-4% growth long term, but it's the smaller, more cyclical part. The focus is on that huge, reliable installed base.
And they're also looking beyond just pools, with Horizon and NPT serving landscape contractors too. Irrigation, lighting, outdoor kitchens. That whole backyard living trend.
Right. They're leveraging their network to capture more of that overall outdoor spend. It's smart diversification, taps into how people are investing more in their entire outdoor space.
So this raises an important question. How does diversifying into backyard living actually strengthen their core pool business? Is it a distraction?
Great question. No, I think it strengthens it. They use the same distribution network, the same logistics, often the same contractor relationships. Pool guys often do landscaping or work closely with landscapers. By offering more products for the whole yard, they become even more essential to their customers, capture more of the homeowner's total project budget. It makes the whole business bigger and potentially less cyclical.
Gotcha. Okay, let's get into part 6. By the numbers, a financial snapshot. Looking at their revenue chart, you definitely see that crazy spike during COVID 2020, 2022. That pull forward was dramatic.
Absolutely sharp increase.
Yeah.
Followed by, a normalization, a steady decline from the peak afterwards as that demand cooled.
And net income did the same, but maybe even more sharply up and down, because margins moved too.
Exactly. Margins expanded a lot during the boom, then contracted a bit.
Yeah.
So net income swings were amplified compared to revenue.
Speaking of margins, though, looking longer term, they seem pretty healthy. Operating margins were doubling from 2010 to 2020.
Yeah, very nice trend of operating leverage pre-COVID. Then the big boost, followed by the hangover. But the key thing is, gross margin has held up remarkably well, stayed right around 30% in Q2 2025, even with the market slowdown.
That 30% gross margin stability is impressive, shows pricing power.
Definitely.
Okay, let's unpack this metric. Return on equity, ROE. You said it's currently around 30%, which sounds pretty good, right? Indicates a quality business.
Very healthy, yes. But here's the nuance. That 30% is actually lower than it could be, or likely will be, because shareholder equity shot up recently. And the main reason equity went up wasn't because they issued tons of stock or took on bad debt. It was because they strategically built up inventory.
That COVID-era inventory build we talked about. Okay, so an increase in inventory might sound like a red flag sometimes, but here it was deliberate.
Exactly. It was a strategic move by management. They saw potential tariffs, inflation, supply chain chaos, and used excess cash to stock up. And the key is, pool supplies don't really go bad. They have a long shelf life. It's not like milk or iPhones.
Right. Chlorine is chlorine.
Pretty much.
Yeah.
So that inventory isn't dead weight. It's more like a hidden asset waiting to be sold. As they sell it down, it converts to cash and earnings, and analysts expect ROE could jump back up towards, 50%, maybe even 60%.
Wow. Okay. That's a crucial distinction. It's strategic inventory, not bloated inventory.
Precisely.
And how about returning cash to shareholders? Buybacks, dividends.
Very consistent, very shareholder-friendly. They regularly buy back stock, reducing the share count over time. And they pay a growing dividend, yielding about 1.5% right now.
So you see dividends going up, share count going down. That's a good combo.
Classic compounding. In Q2 2025 alone, they bought back $160 million in stock, paid out $92 million in dividends, returned over $250 million to shareholders just in that one quarter.
Shows confidence. And the balance sheet, debt levels.
Very manageable. Debt is less than 3 times their normal net income. The debt-to-EBITDA ratio in Q2 was healthy, about 1.47x, plenty of cash flow to cover obligations.
And it's a capital-light business, right? Doesn't need huge investments every year.
And extremely capital light. Like in 2023, CapEx was only $37.5 million compared to over $650 million in operating cash flow. They don't need to build giant factories.
So most of that cash flow can be returned to shareholders or used for acquisitions.
Exactly. And sometimes free cash flow looks different from that income because of working capital swings, especially that inventory. But that's normal for a distributor. In fact, in 2023, they generated tons of FCF from selling down that inventory, even while net income was declining from the peak.
So the inventory unwinding actually boosts cash flow.
Yeah.
Interesting. And long-term, EPS growth.
Pretty impressive. Over the last 10 years, EPS has compounded at around 15.5% annually, plus you get the dividends. That's strong performance.
Okay, let's bring it to the present. Part 7, the current and future outlook. What did the latest earnings report Q2 2025 tell us?
Well, the headline numbers looked pretty stable, actually. Net sales were up 1% versus Q2 last year, reaching $1.78 billion. Gross profit ticked up slightly, and importantly, gross margin held firm at 30.0%, same as last year. Operating income was also slightly up, with operating margins steady at 15.3%.
So stable margins despite the market conditions, and earnings per share.
Diluted EPS came in at $5.17, which was up 4% compared to Q2 2024, so decent bottom line growth.
What drove those sales? Was it still maintenance carrying the load?
Pretty much, yeah. Management said maintenance volume growth and pricing helped offset the continued softness in new construction and remodeling. The recurring stuff is holding up. Chemical sales were up 1%, especially their private label ones. Equipment sales also up 1%. Building materials, tied more to new builds, were down 1%.
And geographically.
Yeah.
Still seeing those Sunbelt variations.
Yep. Florida and Arizona up 2%. California down 3%, Texas down 2%, Europe was strong, up 7%, Horizon Landscaping was down 2%, so a bit of a mixed bag regionally, but overall stability.
Now this raises an important question. Why is that resilience in maintenance and private label chemicals so significant right now? What does it tell us?
It tells us the core engine is humming along just fine. The non-discretionary recurring part of the business is stable, even growing slightly. Even with higher interest rates and economic uncertainty hitting big projects, people still have to maintain their pools. And the strength in private label shows their pricing power and customer loyalty in those essential categories. The moat is working.
And they're still investing, right? PL 360 platform use is growing. More sales centers.
Yeah, PL 360 hit 18% of total sales. They added more sales centers, now at 448. Even Pinch a Penny, their DIY acquisition, saw sales up 1%. They're positioning for the recovery.
So what's their guidance for the rest of 2025?
They're cautious, expecting flattish net sales for the full year. Basically, maintenance growth offsetting weakness in build remodel. They see continued margin pressure, but expect gross margin to stay in line with last year. And their EPS guidance is $10.80 to $11.30 for the year.
Okay, so short-term headwinds are definitely still blowing. High interest rates, people delaying big projects, impacting new builds and remodels.
Right. They expect earnings to trend down through this year, but see a potential return to growth in 2026 if rates ease up and spending recovers.
And that big pile of COVID-era inventory should keep converting to cash and earnings too, right? Draining out of the channel.
Exactly. That inventory unwind becomes a tailwind now, boosting cash flow and eventually earnings as it gets sold.
Beyond the cycle turning, are there other, maybe less obvious, growth drivers? Untapped areas?
Definitely. A few interesting ones. The commercial pool market, hotels, community centers, etc., is about a $2 billion market in the U.S. Pool Corp only has about 10% share there. Huge room to grow.
Okay, commercial. What else?
That Pinch a Penny acquisition targeting DIY owners? Smart hedge if more people try to do maintenance themselves. They capture revenue either way.
Covers both pro and DIY. Makes sense.
International expansion, they're growing in Europe and Australia, plan more centers there. And the Horizon landscaping segment is still seen as relatively underdeveloped. Lots of potential to grow that alongside the pool business.
So, while there are short-term riffles, the long-term tide for Pool Corps seems to be flowing in the right direction, with several places they can make a bigger splash.
That thing's fair, yeah.
And valuation-wise. You mentioned Buffett likes wonderful companies at a fair price. Does Pool Corp fit that now? Not deep value, but fair?
Yeah. It seems to be trading near or maybe even a bit below its historical average PE ratio, which is around 27. The price to free cash flow ratio looks even cheaper, maybe around 20. So no, not a dirt cheap bargain bin stock, but arguably a fair price for a high-quality, dominant business with a strong moat, consistent cash flow, and good growth prospects.
And that free cash flow yield, around 5.8%. That's better than treasuries right now.
Quite attractive on a relative basis, yeah. And the market's growth expectations implied by the current price seem maybe a bit conservative compared to management's own long-term goals. They're aiming for 6-9% revenue growth and steady margin improvement.
Plus, the stock price is similar to 2020 levels, but there are more pools needing maintenance now and fewer shares outstanding because of buybacks. That seems like a better fundamental setup today.
That's a very insightful way to look at it, yes. The underlying business value per share could arguably be significantly higher than it was back then, even if the stock price hasn't fully reflected it yet.
Okay, so wrapping this deep dive up,
Yeah.
what have we really learned here? For me, it's that sometimes the most, unsexy industries hide these incredibly resilient, powerful businesses. Pool Corp might just sell pool stuff, but it's clearly a well-oiled machine. Dominant market position, efficient model, strong moat, reliable recurring revenue. It checks a lot of boxes.
Yeah, and what's fascinating, I think, is that interplay between cyclical new build market and that super steady, non-discretionary maintenance market. Pool Corp's strength is its ability to navigate both. And it's all driven by that ever-growing installed base of pools that just need care year after year. The current headwinds feel more external, market-driven interest rates, spending patterns, not something fundamentally broken with the business itself. That bigger installed base is a permanent tailwind for years to come.
Absolutely. Okay, so here's a final thought to leave you with. Think about pools. They've been around for, 3,000 years? Since ancient times. It speaks to this enduring human desire for leisure, for backyard living. Now think about AI, tech disruption. It's changing everything, right? But is AI going to clean your pool? Probably not anytime soon. The need for clean, functional pools, nice outdoor spaces, that seems pretty timeless. So how does this, chill little pool company just kind of floating along, printing money, how does it keep thriving in this crazy changing world? Maybe just by sticking to its knitting, dominating its essential timeless market. It's not going to get run out of town by AI. It's not fighting cash-burning startups. It's just Pool Corp doing its thing. Something to ponder maybe next time you look at your backyard or see that pool guy making his rounds.